The Footprint Course, Unit 12, Key Auction Reversals. This is challenge day 22 of 30. In the following slides, we're going to focus on how to break those bad habits through a feedback process loop. Listen carefully, get some ideas, and adopt this to finally breaking those bad habits.
Now, if you want to learn to break a habit, it's time you start using pictures. I'm going to show you what I mean. So, I took this from my journal this week. Okay, I've been battling with this for 2 weeks now. It's something that's crept into my trading. It's a result of a bit of frustration. It's a result of there's a number of factors, but you know, I've got a few strategies I'm testing, and I'm getting a little bit overexcited at the moment. And what it's causing me to do is it's causing me to overtrade. In other words, I'm committing to too many different trades across many different markets at sometimes even at the same time. So what I did was I create myself a loop. In other words, I go and I say to myself, I overtrade. It's becoming a bad habit and it's creeping into my trading. I go write down every single emotion that comes with overtrading. Every single thought, every single feeling. Now, some of the emotions I came up with was I found that overtrading is really hard work. Like it's absolutely hard work, and it's extremely exhausting. I'd get to the end of the day and I'd be so exhausted with all the work I've done. Mostly I'd become anxious. I'd feel like, you know, I've done a lot today, I've taken a lot of risk, and suddenly I'm feeling a little bit anxious about what I've done today. That would start to stir a little bit of emotion in me. It would create all sorts of emotions inside of me. When those emotions hit a boiling point, I would start to lose a little bit of control. Now that can be controlled in a number of reasons. One, it could cause me to keep on overtrading. It could effectively, get me to lose focus. All right? That losing focus can again make me more anxious. It can make me more tired. It can create more emotion. But ultimately, it all leads to the same thing, which is a loss. And not just a financial loss, guys, but a loss of confidence, a loss of energy. Right? And in turn, what this creates when I come in the next day is my loop. And it gives me a whole lot more pressure. And guess what I do when I find I'm under pressure? Bang! I continue to overtrade. And the spiral continues, and it keeps going around and around and around. So I've created this habit that's now giving me a feedback loop. And this feedback loop will not stop until I do something about it. So what do I do to get rid of this bad habit? It's very simple. I create the illusion. What does it look like? So it's simple, guys. When you're struggling with something, what I want you to do, what I want you to try, is go and create 2 pages, an A4 page, create it on a visualization wall, do it in whatever way you want. But what you want to do is you want to take all those emotions. So if we go back a page, you can see every one of these emotions of hard work, tiring, anxious, emotional, loss of control, loss of focus, loss of confidence, loss of money, pressure. I want to take every one of these emotions and I want to illustrate it in a picture. Why? Because the brain remembers pictures a lot better than words, a lot better than anything else. So you create the visual aspect, and you create every one of those feelings, that burning, that loss of control, every one of those feelings, and you create a picture, right? Fighting against the wall, anxious, pain, too many things going on at the same time, frustration, wanting to scream, wanting to just be hard on myself, losses, and ultimately just a very unhappy person. You create this visual impact and you stick it on one wall. And then on the other side, you go and say, what will my emotions be like? What will it feel like if I'm not overtrading? And suddenly things like success come into mind. Things like happiness, things like control, things like focus, things like, willing to take more risk, energized, all these positive emotions come into mind. They come flooding into the back of your mind. And you give it a smiley face. And you create the two complete opposites right next to each other. And then you just stare there and you look at it. And you say to yourself, every time I commit to this bad habit, this is the state I am choosing. It's a state you choose because you're choosing to not get rid of this bad habit. And then on the right side, you go and you say to yourself, well, these are the emotions, the feelings, all the wonderful things I could feel if I kick this habit. If you do this, you are going to start teaching your mind to almost create these wonderful little pictures in the back of your head. More importantly, every time you overtrade, bang, guess what's going to come into the back of your head? This guy screaming. This guy fighting the wind with his umbrella. This guy with a phone and a signature and everything coming at the same time. Those are the pictures that are going to come into your conscious mind. And guess what? You are going to deliberately start breaking this habit. You're going to get these constant feedback reminders through an illusion or a picture.
So one of the things you might have noticed was that, as you've gone through a lot of these strategies, you'll recognize that I try and explain where I came to understand a lot of these strategies, and almost every one of them comes through failure. So in other words, it was big losses I was taking, it was errors I was making that ultimately led me to think differently and ultimately create trade strategy. And again, it ties in very nicely with that that mentored session about breaking those bad habits, because if you can't self-reflect, if you can't go and identify, where it is you're going wrong, well, guess what? You're never going to grow from it, and you're never going to be able to ultimately, like I've done, develop other types of opportunities. Okay, this then is now probably a counter-trend specialist strategy. So if you're someone that likes to go counter-trend, this is a fantastic trade opportunity for day traders, but also for swing traders. So I'm going to show you how to identify really good swing points with the key auction reversal strategy. Note, obviously, this is then the first of our context and footprint strategies. What this simply means is that we are going to try and develop a little bit of context within the strategy session. Again, it's not that you cannot just utilize the footprint, you can, but it will be better or more beneficial with maybe, for instance, a candlestick chart or with some other type of contextual understanding. Okay, this is obviously a counter-trend strategy, and it will be an aggressive execution strategy. So again, as usual, a lot of principles are going to be covered, but the highlight principles are definitely number 10 to start off with, as well as number 15, and then obviously the number 20. Those are the three key ones. Number 10, obviously, this entire session is about understanding the interaction with initiative to responsive, and then vice versa. In order to understand when we are shifting between buying initiative to selling initiative, we do need to focus on ultimately what the delta pocket positioning looks like, and who's ultimately in charge. And then obviously, we spoke a lot about tail auctions in Unit 3, so that was ultimately in preparation for this entire strategy session. Alright guys, enjoy the strategy session. This is a fantastic trade opportunity, and hopefully you'll get some real good understanding at the end of it.
So welcome to the practical section then of this unit. Before we get started on the actual the outlay of the strategy, let's just go back and revisit the quote found at the beginning of this unit, which is ultimately developing mental strength is all about habitually doing the things that no one else is willing to do. Okay, so mental strength ultimately comes through habits. Okay, now the reason I want to bring this up is because you might be at that point now in the course where you've done quite a few units, you kind of got the gist and the flow of how this course is working. You've maybe, you're all excited, you found a couple of these strategies in the market, and instead of, at the end of every day, end of every session, instead of completing the template, thoroughly completing it, holding yourself accountable, instead of doing that, you ultimately just move on to the next day and you try and find these strategies again. Now, what I'm going to say to you is if you adopt this process, right, you're not adopting an habitual process. In fact, you're not doing what only a few are doing. You're doing what everyone is likely to do, okay? There are not many people that want to spend their time filling out a template. I can guarantee you that. I think it's one of the most boring things in the world. However, okay, and this is the danger with trading, we get all our sort of external excitement from the P&Ls, okay? So you get rewarded with instant gratification. Instantly, the market tells you, you're a winner, there's $1,000. Now, it's very understandable that you might not want to complete these templates. However, if you are going to develop mental strength, and you're going to develop a real edge and consistency, you're going to have to develop these habits. That is a fact. That is something you cannot avoid. If you develop the mental strength, and you develop the habits, more importantly, what you're going to get to do is have a lot more fun. Okay, that's what it boils down to. Ultimately, if you're willing to develop those habits, you are going to become far more effective, more consistent, and more profitable. Okay, so do those things that not many do, and not many complete their templates consistently and habitually. Now let's move into the strategy. This is all about key auction reversals. We did speak about this quite extensively in Unit 3 when we went over the concept of a well-auctioned high or low. Okay, now we call these tail auctions. Again, briefly, I'm going to go over that. Very simply put, a tail auction is where we just get a very big wick, either to the upside, okay, or to the downside. And that's where it comes from, a tail auction. And we said when we get these types of tail auctions, they do tend to signal out potential lows and highs, and they tend to hold for a couple of sessions. Now, we didn't quite go into how to execute, how to get involved in them, how to identify them, and where the opportunity is. And that's what the strategy session is going to be all about. Now, the most important thing is obviously in terms of the shape. Okay, we call this a V, or an inverse V reversal. Okay, so the name comes very simply. We get initiative into a lower price. Just before the low is found, we tend to get a really high amount of absorption, or known as responsive buying. The market then runs into a certain price point. Now note, this price point is not definable. Okay, I think anyone that thinks that they can pick a top and a bottom of a market doesn't understand the underlying principles behind the market. Okay, it's not that a simple price or that a price it's not that a price is the reason a market turns around. Okay, the reason the market turns around at this price is because a buyer decides to initiate. Okay, now that influence share buyer, he could be a big pension fund, he could be an investment fund, a hedge fund, whatever it might be. Now, the reasons and the logic behind why he begins to initiate, that's beyond us. Okay, we're never going to know why. So why spend our time and energy trying to find prices and try to find the low points and the turning points, where we can simply adopt the process where we identify the price response prior to a potential turning point. We identify on the footprint a few other types of responses, and then we simply execute on that. Okay, that brings us back to the whole concept again of having a subjective opinion, which is guessing at which price a market might turn around at, or looking at the facts and executing based on the facts. Okay, now let's go through some of the other principles that you're going to find in this strategy, and I'm just going to graphically annotate them. So obviously, this is known as initiative to initiative. We spoke about this. So we tend to see the market initiate in a trend-like fashion. Okay, it will run into obviously responsive buyers on the way down. Why? Because as price moves lower, you're going to have a response from buyers. Eventually, it will reach a certain price point where we will see initiation in the opposite direction. Now note, we said this in Unit 3, one of the most important factors is when we get that initiation in the opposite direction, you tend to get little pockets or pocket positioning of absorption on the way up. Okay, we call this responsive selling or secondary responsive selling. Why? Well, it's simple. Obviously, in this down move, in this first little move down, you're likely to have a couple of people caught long. Okay, so when the market does finally bounce, they're simply trying to get out of those positions. Equally, as the market's been going down, you might have had participants trying to average Okay, trying to buy more, just manage those positions a little bit better. So again, when that market bounces, they tend to get out of those positions. You also get new potential shorts entering when the market finally bounces. And last but not least, you get a little bit of profit taking, as some might buy the low and look for small targets. Okay, so that's the basic premise of the initiative to the downside and initiative again to the upside. Now note, obviously, that this will look a lot more trend-like. Okay, so there is going to be a real lack of liquidity. Remember, initiative by the very definition means that there is volume or business that's required. Okay, so there's business to be done, and that requires volume. Now, obviously, if the market, if there is liquidity being provided, that will determine how big the range will be. So the more liquidity being provided, the fewer number of prices that the market will initiate over, and obviously vice versa. Now, in terms of a balanced or imbalanced auction footprint process, what you are going to tend to find is that on the way down with the initiative, you might find pockets of imbalance. Equally, once the market does go back bid up, once we take out those little pockets of positioning as explained earlier, you then might find also some imbalances in the opposite direction. Now do note, we did speak yesterday, we spoke about how, well, not yesterday, sorry, we did speak in earlier units all about imbalances and how they do tend to get filled out. So if there is an imbalance on the first leg of initiative, don't be surprised for the market to stop on the way back up and fill out that imbalance on the way back up. Okay, and again, we will talk a little bit about this and how we can utilize this for execution in a bit. Now, in terms of some of the key metrics, obviously, in terms of the context where you could find this, initiative to initiative price response, it's not something you see very often. Okay, that's the first thing to note. It does tend to come when markets are in an imbalanced state. In other words, the markets get to a point where a larger time frame participant decides that price is now at a point that it's deemed a real discount. Okay, in this example, this would be a discount, or in this example, the market's at a real premium. Okay, so the market reaches a point where we are at a real discount and a real premium, and therefore we get initiation in the opposite direction. And this does tend to come when markets are no longer in balance. Okay, because by the definition of imbalance, it means the markets are in a price discovery mode, and they are discovering a series of prices. Now, some of the things to pay attention to in terms of volume and delta, you will see high volume on both the down leg and the up leg, or both leg 1 and leg 2. You will see a very high volume. Okay, this is obvious simply because we know that with initiative, as we spoke about in the unit on initiative drives, an initiative simply means business in the market, and by definition, volume. Now, as we are obviously initiating in one direction, we have got the potential, as mentioned, to leave either imbalances or what we call low volume areas. And obviously, as mentioned, the delta will accumulate in the direction of the trend. So as prices are rising and we're initiating, we should see the delta go positive to the upside. Once we run into that initiative, okay, at the top, what you're likely to see, and we will see this in examples, we'll initially get a bit of responsive price action there. The delta should flatline effectively. Once we then turn back over and begin to initiate in the opposite direction, again, we're likely to see the delta. Okay, so in terms of the delta, as we begin to initiate then off of the top, we're likely to first run into, again, some responsive buying on the way down. Now note, in this instance, because we have buyers responding, it means that there's going to be likely to be more selling ultimately than buying. So what you're going to see potentially once we turn over is you're going to see darker shades of red. Okay, so we will show this on the charts in a minute, but ultimately you're going to see darker shades as we see that response. Again, we're going to then start to see the delta flip over, so we'll see the delta start to turn negative, and obviously that delta will pick up and increase as we reverse. Now, what that means for the cumulative delta, obviously, is we may go from a positive cumulative delta towards a flat delta, and then eventually a negative delta. Okay, now in terms of some of the other key things to focus on, the last real sort of principle we want to spend time on is the color line. Again, what we do note, as mentioned in Unit 3, I do like to use blue lines for these key auction reversals. Reason being, they do signal out very important turning points in the markets, again, as I'll show you in the next couple of examples. But equally, they do provide us with very good breakout opportunities when we do finally revisit them. Okay, now, the next thing I want to move on to is just to discuss a few of the other principles underlying this trade strategy. Now, I know one of the big questions a lot of traders, kind of always ask themselves is, why does a candlestick have a tail? Okay, and this is quite key to the trade strategy, which I'll express with you in a minute. Now, a lot of the time, back in the day when we just had obviously the use of candlesticks and not footprints, all we'd see was this tail. We wouldn't be able to see what physically, in terms of interaction, happened in there. Now, the interaction, okay, the interaction is imperative, okay, to the next move. So what I mean by that, in other words, if we do get, as a result of that tail, a high negative delta, okay, plus we get high volume on the day, so high relative daily volume, plus we get a weak close. Okay, so if we get those three things, and by a weak close I don't mean necessarily closing on the extreme, okay, I just mean a relatively large wick. So if we get these three principles, okay, this signals to us that there is a very high probability that the next day you're likely to continue in the direction of the tail. Okay, now again, this is so important, because typically what textbooks would teach you, or old way of thinking would teach you, was when you did see one of these wicks or these tails, you simply sell and it continues. Now, I'm going to show you an example where we do have a key auction reversal, but in actual fact it fails and it goes in the opposite direction. Okay, I'm going to show you the reason why. Now, make sure when you learn this strategy, always have a look at the end of the day before the next trading session. Was there a high negative delta? As the case is in this example, obviously a positive delta if it was a buying tail. Was there a high relative daily volume? Why do we require that? Well, remember, we're going from initiative to initiative. By the definition, initiative to initiative should be really high volume. And third, we need a weak close. So if we don't get a weak close, i.e. if we don't close with a relatively large tail, okay, again, that's telling you that maybe the market was just extended a little bit rather than actually seeing some form of a key auction reversal. Okay, now, some of the other things to point out is that what you will notice when we get the reversal is a little bit of thinning out of liquidity. Okay, so I just want to talk a little bit about this reversal. So obviously that's our key price point. Now, once we get below this initial responsive area, what happens from year to year? You're going to find that liquidity will become a premium. Okay, and as a result, you're going to see a low volume area as well as obviously potential imbalances. Now again, this is important to understand, because what we're looking for is we're looking to be positioning ourselves within this area, looking for the flush down. Okay, that's the first sort of real trade opportunity that we're looking for. Whereas the second trade opportunity we're looking for is the next day, where we're looking for some form of extension. Okay, now you will find this a lot easier to see on a time-based time frame, time-based rotation, sorry. And just as a rule of thumb going forward, in terms of what is better, I don't want to give you an exact hard, fast rule, but in general, time-based rotations. Okay, time-based rotations are going to generally work well or better when okay, when the principle requires focus on relative change. So what do we mean by that? Very simply, if the single most important thing is to see a really rapid shift in the volume, okay, it's going to be far easier to see that rapid shift on a time-based time frame. Why? Because if we're looking at 5-minute rotations, okay, that's a rotation, that's a rotation, that's a rotation, and we've done 2,000 contracts, 2,000, and suddenly 10,000. We're going to pick up that variance or that really big relative shift far quicker than if we were looking at on a rotation. Equally, time-based rotations work far better when time is the key proponent. Okay, so when time is a really important factor in the strategy, then obviously a time-based rotation is going to be better to use. Now, rotations, okay, or point and figure rotations, they also have their place. And in general, again, as a trend, as a general rule of thumb, we want to use them when the markets are trending, when we can see flows in the market, when there's momentum, and trending rotations. Okay, so obviously when a market is moving very trend-like, very aggressively, okay, what you'll pick up with rotation is that you'll pick up the pockets of absorption. So you'll see a low volume area followed by absorption, a low volume area followed by absorption, a low volume area followed by absorption, etc., etc. So again, it's not about one being better. There are general rules of thumb to apply them, but you can ultimately use one of the footprints pretty much for all of the strategies. Okay, obviously auction imbalances, again, you know, there is a general rule of thumb. For me, auction imbalances are best used to identify imbalances. You're probably going to miss out on other types of information just having an auction imbalance, especially if you're focusing on the delta coloring. Okay, that's the one thing you won't see on an auction imbalance. So my suggestion, my recommendation, if this is a screen and you have all the footprints, I would simply have 3 different footprint charts, all illustrating potentially maybe having the imbalance on the left, time-based in the middle, and rotation on the right. Okay, and I'd have them all for the same market. And then you can simply just create, obviously, as I've shown you, you can simply just create all your markets, and when you want to flick between them, you simply just flick between the different markets. Okay, so that's how I would recommend you view it, but again, it's entirely up to you. Okay, let's get back to the strategy. I'm going to show you obviously 2 variations and 1 or 2 other factors. So the 2 variations you're going to learn, one is very much a V-shaped type reversal, and what you're going to find in this is as the market does turn to offer back over, the initiative in the opposite direction, as I said, is first going to be met by volume. But what it's going to feel like is it's going to feel like the market's really struggling to allow you in. Now, on a footprint, what this will appear like, if I was to draw a footprint with a couple of prices, what you're going to tend to see initially is you're going to see some very dark colors. So some really aggressive selling. So what you're going to see is some real imbalances coming in from the seller. So real aggressive selling, however, it's being met by buyers. Once we take out that sort of what we call the base of the responsive buying, you will then see the delta color shift, where you might initially see a little bit of darker buy side colors. In other words, you still have buyers maybe buying dark colors, so this will be initially. Second, you might see, again, maybe some darker colors, so last gasp buying. But then eventually, once we get back below that base, you should see relatively light delta color. So that's the first real variation you're going to see. It is going to feel like you're going to struggle to get in, and I will show you this in examples ahead. The second type is why, obviously, this is the first of the strategies that's no longer standalone, but you'll see it on a candlestick. Okay, so what you like you to see on these key auction reversals is some form of an engulfing candle. So if these are your previous couple of candles, Okay, your couple of rotational footprints. What you'd like you to see is an engulfing candle. Now, the most important proponents of an engulfing candle is 1, range expansion, 2, high volume, okay, and 3, in this case, a weak close. So you need a bit of an extreme type close. Now, the strategy is very simple. Okay, in terms of how we're going to execute this play, what we're looking to do is we're ultimately looking to, in the first example, execute once the market turns from absorbing on the bid side to absorbing on the offer. The moment we see the absorption on the offer, that's when we want to enter the short. Obviously, if this was a normal V reversal, we will be a buyer once the absorption comes in on the buy side. In terms of obviously if you're using candlesticks, it's very simple. We wait for this candle to close. Once we get that first bid up, we look for little pockets of positioning. So anywhere on the footprint where we have real large amounts of volume that are traded, the moment it retests that, we want to be leaving limit orders there. So real passive orders there at that pocket of positioning for our entry point. Okay, in terms of time, we are looking for an extension. And we're obviously looking for an extension. Time is quite important. Do note in terms of stop, we can keep a relatively tight stop in both instances. And obviously, don't forget, guys, this is obviously the initial strategy I'm showing you. We are obviously looking for the flush down, for the the real initiative in the opposite direction. But the real move comes the following session. Okay, let's now have a look at some of the practical examples. Okay, so let's take a look then at our first example. This is in the gold market, and it's from the 1st of December. Now, the first thing I want to bring your attention to is obviously the initiative. So we can see the initiative being taken to the upside in the gold. Note obviously the high volume, that's how we know it's initiative. It's also very directional in trend-like fashion. Note the imbalances. We always want to point out those imbalances with potentially green lines. And as we said in the V reversal, what we're looking for is some absorption to the upside. Once the market finds a top and turns back over, we expect to see 2 different bouts of absorption on the way down. The first bit, the buyers should be slightly more aggressive than the sellers, and then it switches over to the sellers being more aggressive than the buyers. And once we take out that point, we're looking for initiative. Now, I'm going to point these out to you. So again, as we come up, we can see a little bit of absorption here, not a great amount. So again, you're probably likely to see better examples than this. Something a little bit like that would have been more ideal towards the eye, just more sort of real responsive price behavior from the sellers. However, as we did turn back over, okay, this is our first little real pocket of real aggression. Okay, what we can see here is obviously the buyers being quite intentional. The buyers really just trying to keep the market bid up. Note once it got taken out, we then moved on to potentially our second little pocket. In this instance, what we're seeing now, if I draw a little bit of imbalance lines for you, you can really see how suddenly the sellers start to step it up, and we start to see a little bit more of an aggressive sell side response. So we shift away from obviously the buyers being more aggressive than the sellers in the first block to the sellers becoming more aggressive than the buyers. And that's key to the strategy. Obviously, we need to see those sellers step it up and initiate, and obviously time is of importance. Now note, these are obviously 5-minute rotation, so it is quite nice and easy to see. You can see the natural shape of the V. Now, what we're looking for in terms of the trade strategy, once the market does have this initial pullback into the imbalance area, the market offers a bounce. Now note where that bounce comes to. It comes all the way back to this really, really dark little area here. Okay, that seems to be the last area where the buyers took a stand. Market tests it with relatively low volume, and we can see both these prices. Okay, relatively little volume traded there. That would have been quite a nice clue. And we then got a little bit of, as we could again see, some aggressive selling coming in, but the buyers holding before we then got the release. So there's paramount, there's quite a lot of opportunity to get involved in this instance. So you don't need to rush into this trade strategy. Note, obviously, as we said, when we initiate in the opposite direction, we do tend to see the imbalances taking place. So we can see a real low volume area here. also some potential imbalances. Okay, now the most important thing is we are looking in terms of a target. We are looking for the initiative to play out. So we do want to see maybe either the delta, well, in this case, maybe either the positive delta unwind, or we want to see the market flush down, maybe form a little bit of an exhaustion low, or run into what we can see a liquidity. A number of factors would represent a potential target. However, what I would say, bear in mind, and this is the most important part about the strategy, when you get a good key auction reversal, it tends to last for a couple of days. Now note, you will only know this by the close of the session. So the first strategy, which is the completion of the V, that's strategy number one. In other words, once we take profits maybe on this candle or this candle, we are flat. Okay, we don't hold a position overnight. We need to wait for the close. Now, the three important elements of the close. One, we need relatively high volume on the daily. Okay, why? Well, because we're going from initiative to initiative price action. Two, we need the delta to reflect. So in this instance, we would want to see, a delta of, say, minus 1,000 or whatever it may be when the day closes. And three, we obviously want to see quite a relatively large wick. Okay, so a weak close or quite a relatively large wick. Okay, so that's our first example and our traditional, what we call inverse V or V reversal. Now, the second example we're going to look at is utilizing obviously the candlesticks. As we mentioned, the second variation, this is from the 20th of November in the E-mini S&Ps. Again, a 5-minute base time rotation. Why? Well, because it's a lot easier to see these on a time frame based rotation. Note this time, obviously, we get a far more obvious type price response. So the market comes up. Okay, note obviously quite a lot of aggressive buying. So there we see the response of selling. Right, the market then again, as we move into that initiative point, we can see that initially we see that responsive buying as the market turns back over, and eventually notice what happens. Okay, so we start to see some really aggressive initiative selling. Okay, and that's our pretty much our key or our clue that potentially the trade is on. However, we can obviously, like I said to you, if you're not so sure about this trade strategy, just using the footprint, you can use the candlesticks. Okay, so we can very clearly see here, this is a engulfing candle. We can see by the candlestick on the left side, obviously exceeds both the high and the low of the previous candle, also expands on range, and most important, volume, which is quite a key component. Now, when we see these engulfing candles at extreme points combined with the price action required for a key auction reversal, we want to be switched on. Once we get the start of the next rotation, we're looking to sell into the bounds at the previous absorption point, and that's exactly what we've got here. So we can see this was the last stand taken by the buyers. Note the incredible amount of volume, almost 7,000 contracts traded at this price. The market ticked up by one price, gave you a chance to get filled before we initiated in the opposite direction. Okay, obviously in terms of target, what we're looking for is the really big initiative in the opposite direction. We can see that with not just the high volume, but also the high negative delta. Now, like I said to you, so important is to always look at the close. Now, this is obviously the daily candlestick. Now, remember the three proponents. One, we need high volume. Two, we need a wide wick. And three, we need obviously the delta to reflect. Now, on this day, we ended up closing positive delta. Okay, we ended up having a really big buying wick. And third, we ended up having a relatively strong close and high volume. Okay, so this wasn't a great example of a key auction reversal that had potential for follow through on the next day, hence why we got some continuation in the opposite direction. Now, as I mentioned to you in one of the principles, when we do get these key auction highs and lows, we put ourselves a nice blue line. Why? Because they provide great potential opportunities for breakout trades. Okay, remember, the reason they're good breakout trades is very simple. To create and provide this kind of liquidity and then offer an aggressive amount of liquidity is a really, really big position. Okay, so there's a lot of positions caught up in the market once we get that initiative to the downside. Okay, so by that definition, once we take that out, we should see quite a fast unwind. Okay, that's why it creates a great breakout trade. Now, what we're going to do is we're going to turn our attention to a video and we're going to watch the first of our key auction reversals. So this is the oil market. Alright, so let's take then a look at our first example. This is from the WTI oil on the 16th of November. Now, obviously, just some key things to focus on. Obviously, as we're coming down, we don't know where this is going to turn. We don't know what the initiative price action is. We're simply just observing the market, and if we see certain elements or certain characteristics from the footprint, we then execute based on the strategy. Now, the first thing to notice how we get these really dark colors at the extreme. Okay, that's the first little bit of a response taken from the buyers, so we can see some real buying absorption coming in. The market then extends lower, and note straight away 329 traded at 95. Potentially, we could have thought of that as a potential little elephant. Quite a lot of absorption there. One order taken out. Market trades that order, goes back bid the first time. Now, again, note the dark red colors, so we can see some real buying absorption taking place here. The buyers are happily getting hit here, happily providing liquidity to anyone willing to sell. Market goes, extends again by another tick. Notice the volume going through there. Okay, really low volume on that extension. Straight away back, but below the 348. And again, we continue to see quite a lot of buyers absorbing these low prices, so providing liquidity to the sellers. Now, again, this in its own does not signal any kind of potential trade strategy, but what happens next potentially does. Now, I'm just going to fast forward this slightly. So we can see obviously the market spends, obviously these are 5-minute rotations, so we can see the market does spend a little bit of time in this lower rotation, and we move from these dark colors to suddenly these light colors, and that's the real key here. Okay, so obviously what we said is we want to see the market go from responsive, we want to see it initiate, run into those secondary sellers which we're seeing on this block. Okay, so we can see that bunch of sellers getting involved, providing liquidity here. And once we take those out, again, notice what happens now. So where those sellers were providing liquidity, notice how suddenly now we're getting the buyers providing that same liquidity. So someone is selling it into this block here, but ultimately what we're getting is quite a lot of reloading coming in from the buyers. And that was our clue, that was our signal. When we see that, we want to be looking to enter long before we then get the initiative leg. And we can see that initiative leg come in now, real light volumes, nice and balanced there, 30 by 90, and continuation to the upside again. Notice the real block of absorption here. This is where you just got to be so careful thinking that red means that sellers are dominating the price response. Okay, it all depends on the context. Okay, so we can see prices have come off the low quite aggressively. Yes, there is more selling taking place here, but it's in the process of prices rising. In other words, there's more selling taking place only simply because buyers are holding much higher prices. Okay, in that instance, the likelihood is we're going to continue on higher. Okay, and that's what we see. We continue to see this process of the unwind towards the upside, and we continue to see the initiation again. Notice the low volume area, notice the imbalance, and also notice the follow through. Okay, so that's our first example of what an auction reversal will look like. Do note we would go put a nice little blue line down there if and only if it met the 3 principles of a really good auction high or low. Now, the next example we're going to take a look at will be in the E-mini S&P 500. Again, note this is an imbalance chart, also on a time frame. I just want to illustrate to you guys that you can use any one of the footprint tools and you're still going to see these rotations or these reversals. Now, in this example, this is a little bit of a softer version. This is that engulfing candle I'm going to show you. So I'm going to get to the point where we do engulf, so we can then take it from there. Okay, so the market goes bid. Let's just rewind that a little bit. So let's see the process of going bid here. So the market gets to 2640. Notice, obviously, the market finds a bit of volatility above this 2640. Why? Well, we can see in the candlestick chart maybe a little bit of a break of a flag. Market extends. Note the imbalance. Okay, so we can see really aggressive blue lines there, nice imbalance, showing some aggression to the upside. Really good amount of volumes transacted. Now, what we're looking to happen ultimately is we're looking to see it initially. We're finding responsive here. As we can see, we're seeing the sellers respond. Once obviously the buyers have run into enough responsive selling and the sellers step up and initiate in the opposite direction, we should see prices start to drift in the opposite direction. And that's what you can see here. Obviously, we can see that we're seeing quite a lot of moving from a very aggressive buy side. We've seen that entire imbalance get filled out, and we've actually seen the sellers step in and become quite aggressive. And that's the nature of this trade strategy. It's a very quick flip around from buying initiative to selling initiative. Okay, now let's get to the point where we obviously get the engulfing candle. So we can see we're looking for the next rotation. That is our rules. We wait for the next rotation, and we're looking to sell on the first bit of absorption. So somewhere around that 40s, that's where we would look to be a passive seller, leave some offers there. Now note in this example, the market comes bid, comes all the way up to 39s. Unfortunately, it doesn't quite give us the 39 straight away. Now, time is of importance, obviously. So again, if you don't get filled in that first rotation, don't be afraid to be a little bit more aggressive on your entry. Reason being, it's simple. If you know you're going to get quite a measured move, i.e., a good rotational move in the opposite direction, you can afford to take a slightly bigger stop. So don't be afraid to in this example, pay down. Now note, eventually the market gets moving, and we start to see the market initiate in the opposite direction. Now, what I do want to point out, and this is one of the key differences between obviously an engulfing type candle versus the V-shaped type reversal, is that, and like we mentioned obviously in Unit 3 as well, is in the V-shaped reversal, the follow-through or the initiative in the opposite direction tends to be far more aggressive. Okay, in this example we can see, again, it's still rotating lower, we can still see the red candles, but it's far more stepwise and grind. Okay, that now brings us then to the end of the examples for this unit. Let's now move back onto the slides and complete the template.
enjoyed that strategy session and the examples, and hopefully you're excited now. I think at the end of every one of these strategy sessions, you should really be getting revved up to just go and apply yourself into the market. Now, again, what I would say, put the brakes on. Don't develop bad habits early on. Make sure you're completing the templates. Follow the process. My old boss in my first ever job used to have a wonderful expression of, there is always method in the madness of a process. And sometimes we think processes are silly and we don't understand the point of them. But in time, as we grow, I'd like to use the word wiser, we do tend to recognize how important these processes are and why we follow them. That being said, let's follow the process. Let's complete the template together. So obviously in terms of market context, the initiative to initiative, by the very nature, is trending to trending. We do see obviously the small phases of absorption, from the obviously response as well as the secondary response. I did go through that in quite a great detail. So as you're completing this, again, go run through that process of interaction that you see when seeing this trade strategy. In terms of balanced, imbalanced, you're going to see this in imbalanced markets. Why? Well, simply imbalanced market auction theory suggests that key auction reversals occur when prices are at a discount or at a premium. In terms of trade location, at the extremes, note obviously with the name for this is the V or inverse, the V or inverse V, and the two variations were ultimately the symmetrical V or inverse, as well as the engulfing or outside candles at the extremes. Those are the two variations we discussed. So again, highlight this, in terms of where we're trading, where did it occur, and ultimately you can draw upon that information down the line. In terms of conditioning of the markets, note initiative requires large time frame participants, so we're going to be seeing a lot of them. Because of that, liquidity will be relatively low as we initiate in one direction, and then again low as we initiate in the opposite direction. So just keep that in mind. Obviously, as we do see this initiation, liquidity does tend to be at a premium, hence why we tend to move the way we do. Bear in mind, as I always say, or that I've mentioned a number of times, the degree of how far a market will move is all based on how much liquidity is being provided to those participants. More liquidity, smaller move. Less liquidity, much further a move. Okay, in terms of volatility, it won't be excessive. This is the interesting thing. Most people tend to think it'll be excessive. It won't really be. Simply because it's unusual for markets to do these sorts of, V reversals. Okay, it's very unusual for a market to go straight line up and then straight line down. Okay, I have that expression that I've shared with you earlier on the course. It takes time for a ship to turn, but every now and again that ship turns pretty quickly. And when it does, you have to make sure you've got a rules-based approach or a strategy approach to executing. And if not executing, make sure you're avoiding, losing too much when there is fact-based information in the marketplace. Okay, let's now move on and talk about strategy identification. So the interaction was probably the key to understanding this entire strategy. If you want to get good at the strategy, you're going to have to be almost like a professional interaction specialist. Just like footballers, you get professional or guys who take the free kicks all the time. It's a similar thing. If you really want to be good at the strategy, you're going to have to learn to recognize when we have that very aggressive switch in price action from initiative to initiative. Now, note obviously, in terms of the interaction, we do get that initiative until we find that responsive, that first bit of responsive. We then obviously see the opposite side taking initiative, which runs into very, very short-term secondary responsive before seeing the continuation of initiative. We did cover that quite extensively, so again, make sure you build upon that interaction within this template. Do note it is a very aggressive interaction at most parts of the strategy. In terms of obviously what I've included here is daily continuation requires the following. Now, we spoke a lot about how we can identify the potential for a trade the following session. Now, bear in mind there were two strategies, there are two variations. One is on the first day and the second was on day 2. And we spoke about ultimately, in order for there to be continuation on day 2, we require a large relative tail, it's a weak close or a strong close. We also require cumulative delta in the direction of the reversal, and then also a high relative daily volume. Okay, so the reason for the high volume obviously was because when we have initiative, it means there's high volume by nature. Therefore, initiative to initiative means there should be a really big amount of volume. Okay, in terms of the metrics, note when we have initiative, as we mentioned in one of the earlier units, initiative does tend to hold consistency with the volume. So you don't want to see low volume in terms of the metrics. And do note, you will most likely, on a really good reversal candle, you will see probably one of the highest daily volumes, recorded within a couple of days, weeks, months. Now, in terms of time, time is quite important. You want to, like I said, it's ideal to have the strategy on a time-based rotation, simply because you can see the really aggressive auctioning in the opposite direction. Now, we said time is crucial because time will reflect whether we get some symmetry in terms of the rejection, and obviously if we have an engulfing candle, well then we expect continuation on that engulfing or outside candle within the next couple of time frames. So again, pay attention to time and do factor that into your analysis. In terms of delta, it'll be light in the initiative for obvious reasons. We will see dark patches obviously with absorption and reloading. Now note up which stars they're next to absorption and reloading. I just want to really clarify the difference. Now, absorption, as I've utilized throughout this course, is simply where if a market's going higher and suddenly someone starts to sell it, but a buyer holds higher prices, he's simply absorbing the market at higher prices. We can also say it in terms of vice versa. Now, in terms of reloading, there's a slight difference between absorption and reloading. Okay, reloading technically comes from the price ladder or the depth of the market, and reloading simply means it's one order being reloaded. So on the ladder, you would see it says someone had a 100-lot contract, and as someone begins selling into that 100-lot contract or into that 100-lot bid, ultimately the buyer reloads it back up to 100 and constantly reloads it, getting a fill of ultimately their long position. So that's the main difference between reloading or absorption. In effect, they do mean similar things. They are very, very similar. Absorption, however, I'd say technically happens over potentially more than one price, okay, whereas reloading tends to signal out one price. Okay, in terms of then the cumulative delta, we will obviously see accumulation in terms of the initiative, and then obviously it will reverse as we get initiative in the opposite direction. In terms of the relative change, it will, we will see a relative change in price direction. That is the real key. It's a sudden shift as prices move up to a sudden shift of prices moving down, and that's the real nuance to the strategy. It's knowing that interaction between the buyers and sellers and seeing it being reflected in the relative change of price. Okay, in the next slide, we're going to finish off our template with the execution part of the template. So then in terms of the execution methodology, in terms of money management with the strategy, note we want to be passive at the absorption. So we spoke a lot about where we're entering, how we managed to get ourselves onto this very key reversal. We're looking for the break, or we're looking for the retest of that secondary absorption, before we enter in both variations that was. So whether we were talking about the symmetrical V or inverse, or even the outside engulfing candle, either case, we're looking for that secondary absorption, and that's where we want to be entering in passively. Now, in terms of risk, we obviously place it beyond the absorption point. Again, do note, don't be too tight on this risk. We've got really good risk reward here. So again, you can afford to be a little bit loose. Well, not loose, that's probably the wrong word. You can afford a slightly bigger stop, given that there is a really good opportunity as the initiative kicks in. In terms of target, well, as we say, initiative in the opposite direction. So once we get that initiative, whether we extend on the previous extreme, or we retest the previous extreme, or maybe we get a full unwind of the delta and form an exhaustion high or low, those will all be key signals in which you want to look to take profits. Now note, very crucial, this is not something we want to hold overnight. We don't want to assume that the market will continue with the trend, that it is necessarily a key reversal, okay? That's the real key to becoming, a really good trader, is to recognize, that Of course we'd love to stay short. Of course we'd all like to run it forever and make the biggest winners. But objectively, that sort of approach is never going to allow us consistency in the long run. Okay, what allows us consistency in the long run is to continue to adopt an exact process. The exact process therefore tells us we are flat by the end of the day. If, however, the market does close with those three parameters, i.e. a nice big tail, big volume, or a cumulative delta in the direction, we will then look to enter with the trend or with the continuation of that key reversal in the following session. Okay, in terms of risk reward, very high, tight stop, and really good reward. In terms of application, it's exact. Okay, there's no guesswork here. We've got a very, very easy entry point, very exact entry point. And in terms of leveraging, we don't tend to leverage. And the reason is not because we're afraid, not because we're not convicted, but simply because, like I said to you, it takes time for a ship to turn. A lot of the time, it's quite difficult and tricky to be aggressive at an extreme in the face of an aggressive trend. Okay, so by the very definition, it's okay to be a little bit nervous to take on this trade because you are going, 100% counter trend, but you're going counter trend based on facts coming from the market. So in that case, we don't leverage. And in terms of a tip, don't panic. Okay, don't panic into the strategy. It will. This trade strategy will provide a really large opportunity, and so you don't have to panic in. Be patient. Wait for those two types of absorptions. Once you get the secondary absorption, don't be afraid to get in on a retest. All right, guys. Let's now move on to the next part of our additional reading section.